On June 25, 2021, a car wash company based in Tucson, Arizona, rang the opening bell on the New York Stock Exchange. Mr. Car Wash, a business whose entire purpose is washing cars, raised approximately $1.25 billion in its initial public offering and debuted with a market capitalization of just under $6 billion. That made it, on its very first day of trading, more valuable than Cracker Barrel, more valuable than Denny's, more valuable than most regional American banks that had been operating for over a century. Wall Street wasn't confused by this. It was enthusiastic, because over the previous decade, something remarkable had happened. The American car wash hadn't become dramatically better at washing cars. It had quietly become one of the most attractive financial assets in the entire service economy. Private equity firms spent years buying independent car washes across the country, one by one. They standardized operations, changed one seemingly ordinary part of the business, and suddenly found themselves owning companies worth billions. The strange part is that customers barely noticed anything had changed. They still drove into the same tunnel. They still got the same clean car. Wall Street, however, was looking at an entirely different business, and understanding how that happened tells you something genuinely important about how modern finance finds value in places most people never think to look. The problem Wall Street had to solve. The obvious way to think about a car wash is as a transactional business. A customer drives in with a dirty car. They pay $10. They drive out clean. Simple enough. The problem is that businesses like this are incredibly difficult to value. Revenue depends on the weather, it depends on the season, it depends on local competition, and it depends on thousands of individual customers deciding their car is dirty enough to justify a visit. For investors, that's a nightmare. Unpredictable businesses command modest valuations. Predictable businesses command extraordinary ones. So private equity firms weren't asking how to wash more cars. They were asking a completely different question. How do you make one of America's most unpredictable service businesses produce predictable cash flow? The answer turned out to be surprisingly simple. The subscription that changed everything. The innovation wasn't robotics, it wasn't automation, it wasn't artificial intelligence. It was a monthly subscription. Unlimited membership plans completely changed the economics of the industry. Instead of paying every time they visited, customers paid a fixed monthly fee, typically between $20 and $40 for unlimited washes. To customers, it looked like a good deal. To investors, it looked like recurring revenue. A location with 10,000 subscribers now generates hundreds of thousands of dollars every month before a single additional customer drives through the tunnel. Rain matters less. Seasonality matters less. Individual customer decisions matter less. The money arrives on the first of every month, whether people wash their cars that week or not. And that's exactly the kind of business Wall Street is willing to pay a premium for. There's another advantage. Most subscribers never use the service nearly as often as they imagine they will. People consistently overestimate how often they'll go to the gym, stream movies, or wash their cars. The industry quietly profits from the same behavioral bias that powers almost every successful subscription business. Customers thought they were buying unlimited washes. Wall Street thought it was buying predictable cash flow. And once predictable cash flow entered the picture, buying a single car wash stopped being interesting. Buying hundreds became irresistible. The roll-up machine. Once the subscription model proved itself, private equity firms had a clear playbook. The American car wash industry contains more than 60,000 locations. The overwhelming majority are independently owned. A retired couple with one location, a local entrepreneur with 3, a regional operator with a handful more. From a private equity perspective, that's almost the perfect market. The strategy works in stages. Acquire a regional operator. Use it as the platform. Buy smaller competitors nearby. Standardize operations. Introduce the subscription model everywhere. Fold every location into the same brand. Repeat. Every acquisition makes the overall platform more valuable than the individual businesses ever were on their own. That's exactly how Mr. Car Wash expanded from a regional operator into a company with more than 400 locations before eventually going public. The first car wash barely mattered. The 400th one did. The individual businesses were no longer the product. The platform was.
The asset hiding underneath. Subscriptions weren't the only thing private equity was buying. They were also buying something many independent owners had never fully priced in: the land. Express tunnel car washes require very specific locations: busy arterial roads, large lots, high visibility, easy access. Many independent operators bought those properties decades ago. Land that once cost a few $100,000 can now be worth several million. In some cases, the land underneath the business became worth more than the business sitting on top of it. Private equity firms understood that immediately. Sometimes they went even further. After acquiring the business, they'd sell the real estate to a REIT through a sale-leaseback transaction. The operating company received fresh cash to fund more acquisitions. The REIT gained a long-term tenant with reliable income, and the investors extracted value from the business and the property separately. The original owner often saw one investment. Wall Street saw two. Why this keeps happening? This isn't really a story about car washes. It's about a playbook. Find a fragmented industry, create recurring revenue, consolidate hundreds of operators, standardize operations, build scale, then sell the platform to institutional investors at a valuation no independent owner could ever command alone. We've already seen the same strategy applied to veterinary clinics, dental practices, urgent care centers, pest control, residential plumbing, auto repair. The car wash simply makes the strategy easier to see. The temptation is to frame this as straightforward corporate extraction. Wall Street arriving in local communities, buying ordinary businesses, and financializing something that worked perfectly well before. There is some truth to that. Subscription cancellation practices have generated widespread consumer complaints. Prices for occasional customers have risen, and many independent owners sold businesses that became dramatically more valuable only after consolidation. But that's only part of the story. The subscription model genuinely improved financial stability. Standardized operations often created more consistent customer experiences. Larger organizations could invest in equipment and maintenance that many independent operators simply couldn't afford. The bigger lesson is this: Wall Street rarely invents value. It identifies value that already exists inside fragmented industries and reorganizes those industries until that value becomes visible to institutional capital. That process creates winners, it creates losers, and it almost always looks cleaner inside an investment memo than it does on the ground. The next time you drive past a shiny new express car wash, you're probably not looking at a local small business anymore. You're looking at a financial asset disguised as one. The car wash was always worth more than it looked. It just took a subscription model, a roll-up strategy, and billions of dollars in institutional capital for everyone else to notice.